Today, inside Melbourne property. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Today I'm joined by Catherine Cashmore from Melbourne. Hi Catherine.
Hi Martin.
Great to have you back on again, and thank you very much for stepping into a local cafe. You're unlocked down there, so you can do that, and
Yes.
sharing your audio with me. And I want to pick your brains about Melbourne property and what's been going on and what might be going on ahead. But just by way of introduction, why don't you just make sure that people understand who you are and where you're from?
Sure. Well, I work as a buyer advocate in Melbourne. And so that's one of the things that I do with on the ground, helping home buyers, investors get into the property market. But I also write two products for Portfolio Publishing, Cycles, Trends and Forecasts, and Cashmore's Real Estate Wealth. Cycles, Trends and Forecasts focuses on the land cycle and stock market cycles, and teaches people how to invest based on when the market's going to boom and when it's going to bust. Cashmore's Real Estate Wealth helps people understand, cut through the spruik, property market spruik, and understand where they should buy to make the best choices that they can in the property environment. And I'm also president of Prosper Australia, which is Australia's oldest economics organisation. And we campaign for tax reform. What we want to do is we want to stop the booms and the busts in the housing market, and we want to make land affordable. And so we campaign for a land tax and to take taxes off productivity, income and productivity, and to put them onto land. So those are the three things that I do. So good to be here.
Well, thank you. And, I'm breathless after all that, and I'm just listening to it. But it's all sort of connected, isn't it? That's quite interesting, right? Because obviously property is such a big thing across the whole of Australia. You know, we've got a lot of our wealth tied up in property. We've got a lot of debt in property. And of course, the political cycle has also very much centred around property. So it's really, really important as a topic. And there are so many things that probably aren't behaving the way that you would like them to behave. So let me sort of start firstly with just a little bit of a sense of Melbourne property. Now, the top level story has been bit of a crunch through the lockdown, but quite a significant boom, particularly in the, house end of the market, house land, less so maybe for units. But what are you really seeing on the ground?
Yeah, the housing market has gone crazy, and I think we've seen that everywhere. There was a story that came out today talking about Melbourne values being up over 16%. That's a little less than they are up in Sydney. This is over 12 months, over a 12-month period, and of course Hobart's also roaring ahead. The other states are doing well. I think it's interesting in Perth because the rents are so far up and the prices are lagging a little bit, but it will get there. But Melbourne's been experiencing what the rest of Australia's been experiencing, and land prices, what you could buy last year, you're paying in some situations 200,000-300,000 more. So to give you an example, an area where I purchased quite a lot of property for developers is Aspendale. It's a southeastern Bayside suburb in Melbourne. And at the end of last year, around November, December, we were purchasing land there for around $1 billion, just coming out of the, sort of just entering the post-COVID property boom. And now it's tough to get in there for 1.4, 1.5 on those same blocks. So there's no reason to it. There's no fundamentals that support it. The rents in Melbourne are going backwards. Vacancy rates are generally higher, though they're not high in Aspendale. We can touch on the reasons for that. But the prices are going crazy. And of course, that's just a feature of the economy that we're in. So you mentioned how the economy revolves around the property market. And really, when you study cycles, the land cycle sits at the base of all the economic cycles because we use land for everything. We live on it, work on it, sleep on it. Everything around us is made from land. And of course, so much of our political environment encourages speculation in land. So you see when people don't know where else to put their money, which is right now, money is a liability with interest rates going down and probably going to go down further. And you see them pouring it into the property market. And that's just been, like I said, no fundamentals to back it, just pure speculation.
Right. And of course, the point there is that if the settings don't change, in other words, rates stay really low and lending standards stay really loose, and we get more government support, the trajectory could be that prices will go on going up, but beyond any reasonable correlation. I mean, I can't correlate prices to anything useful in terms of income or in terms of anything else, right? As you say, there's no rhyme or reason other than, it is a speculative environment that we're in.
Correct. We've been forecasting that we are facing the biggest boom that we have ever seen in the property market over these next few years to the peak of the real estate cycle. And that's because of what you've said. There's so many drivers pouring into this. So it's not just, the fact that interest rates are low, and not just the fact that the government won't do anything to touch the property market. You've seen even in New South Wales that when they try to stop construction, when they try to wind that back, the protest that was carried out from the construction industry worked.
Yep.
The protest that was carried out from everybody else calling for freedom and a little bit of loosening of the restrictions so that they could work didn't work. And that's not just been a feature of Australia's environment, that's a feature of the worldwide environment when it comes to the property market, anywhere which encourages speculation into property, which is, certainly, areas England, Europe and America. So we've seen exactly the same.
So in terms of that sort of long time cyclical view, I know you have a view though that ultimately this may come back to a bit of a crunch, and it might not necessarily be a completely soft landing.
When the market goes in the next economic downturn that we will have, which will be going into 2027, 2028, it is forecast to be a property crash. And I think that what's happened in Melbourne this time, in Australia this time, is that there's a lot of people that are just believing now that property will never crash in Australia. I spoke to somebody, institutional investor, not so long ago, a couple of weeks ago, just before Melbourne's lockdown, so maybe 3 weeks ago, and we were discussing, he was talking about, encouraging people to invest in the property market and setting up property funds. And he said that to me, well, properties, we've never had a property crash. And I said, well, the early 1990s was a pretty bad crash. And the problem is that the median price in the 1990s downturn dropped 10%. And so people think, oh, well, that's nothing. It was mild. But when you look at the individual property prices of what happened in Melbourne, property prices in various areas of Melbourne halved in value. So from what they were selling at the peak of the cycle around, sort of 1987 to 1989, and then they halved a few years later. So, crashes they're very bad, and they're very bad for the whole economy, because an economy that props itself up on the land market is an economy that, when the land market goes, it suffers a really bad downturn, not just a stock market. A lot of the stock market is propped up with property as well, but not just in the stock market. But when the housing market goes, it affects rich and poor alike, because the mum and dad investors that we always get told are out there investing as if we should have, some sympathy because they're mother and father investors. They're the ones that therefore lose all their wealth because they've been encouraged to put their money into property by the tax system, by encouraging speculation, and then the property market crashes and everybody's wiped out. And it's a longer and more sustained downturn. So that was the real thing with this downturn, where the property market doesn't crash, there's a quicker recovery on the other side of it. And no surprise, all the stimulus pours into the property market and infrastructure, which pushes into property as well.
And interestingly, of course, the economy overall in Australia is very skewed, isn't it? I mean, we dig out resources and ship it off to China at the moment, but a lot of the rest of what we do is all around property. And so therefore, the risk basket that we're in with regard to property is so huge that if it does take a tumble like you're suggesting, that is economically extremely serious.
If it takes a tumble, we go into a financial crisis. If the prices drop below the funds that have been loaned out in the bank, so if the collateral is not there to support them, we have a banking crisis. And you understand from repeated history over every downturn that anybody can remember, not just in Australia, but elsewhere that has similar policies, that the banks are bailed, taxes are hiked. It's a very painful experience to go through. So absolutely right what you're saying.
And, I come from the UK where we went through, I think, 4 crashes over the time I was in the UK when prices dropped significantly. I lost, I think, 30% in one of those cycles just because I had to sell because there was no choice. And unfortunately, I said that to people in Australia and they turn around and say, no, it never happened here. But, the fact is history is against us, right?
Correct. Yes, it has happened here. And just because we missed out on the 2008 downturn, doesn't mean that we're going to miss out on the next one. In fact, if you look historically, even over recent cycles, if you have a mild one, you're usually up for a severe one next time. And that's why I would have, I would expect that. The point is when we get to around 2027, 2028, as we're going into a downturn at that point, when we're past the peak in the economy, the world is going to another synchronized property-led downturn. It's extremely painful, and people need to understand that is where the cycle is. It's what it's saying. And so you can invest in property in the meantime, and unfortunately, whatever your stance is against it, no matter how much we might not like it, we have little choice because the taxation policy dictates how we are going to invest, and nobody will earn a good, you don't earn a living, right? There's nobody gets rich from earning money. You get rich from monopolization.
Yes, and it's interesting. There was an article, I think, the other day in New Zealand highlighting that politicians in New Zealand who are very property owners were making a lot more over the last 12 months from their property portfolios than they were from their quite hefty salaries as being politicians. And that's just a microcosm, right? Because you're right, people tend to make more money out of the property cycle than they do out of, going to work week in, week out. That's just the nature of the beast until it stops. And that's the risk.
I mean, I've had many experiences in Melbourne cycles where people are, becoming wealthy from their property outside of anything that they're able to earn. And I'm talking about people that are very high earners, but their property is their capital growth. Well, it's like the, John Mill used to say, the old classical economists say, owners grow rich in their sleep without working or economizing. And as they grow rich from the wealth of their land for no effort at all.
Yep. Doesn't seem totally equitable, but that's the way the world is, so it's worth understanding that. Let me come back specifically now to a couple of specific questions relating to Melbourne property. I'm very interested in Docklands and the new high-rise that's been put up there over recent years, because I look at some of the statistics there in terms of the rent drops, the vacancy rates, and the price falls, not rises, in those areas at the moment. And I think you've probably got a hypothesis that there's a lot of vacant property in that part of Melbourne.
Well, we've been doing studies at Prosper Australia. They're called speculative vacancy reports. You can get them on the Prosper Australia website. I think we started it off in 2007, looking at where long-term vacant dwellings were. So this isn't properties that are advertised for rent, and it's not properties that are advertised for sale. It's properties that are sat vacant for 12 months, and we analyse it based on water usage data. And so we work out what people, how much water you will use, the minimum amount of water that you need to use to live in a property, flush the toilet a couple of times a day. And then we work out, who's at home and who's not at home. And the Docklands is, there's been times where it's come out higher than other times just based on where we are in the building cycle. But in some of those reports, we've uncovered over 80,000 properties. So not only in the apartment market, but the apartment, as Melbourne has grown up more than it's grown out, and really historically we used to grow out more than we grew up. As we've done that and we've built more apartments since Melbourne was rezoned, the vacancies have just exploded over that time. So Yeah, I mean, our reports have been very successful at Prosper Australia. We do it on Melbourne because a lot of the apartments use single water meters, and that's not the case in Sydney. So we're able to analyse the data like that. It's not perfect, but it's a much better measure than you can get just looking at vacancy rates, which are based on, properties that are put up for rent in the short term. But talking about, the Docklands in general, I mean, the advertised vacancy rate for the Docklands during COVID, so I think by the time we got to around October to December last year, had gone up to 18% in the Docklands, which is all in the apartment market. That's just properties that are advertised that have lost their tenants, or properties that perhaps would have been used as Airbnbs and went onto the long-term rental market. But that's unprecedented.
Yep.
And the agents in the city were saying to me it's an apocalypse. They'd never seen anything like it. Apartment apocalypse was the term that was kind of, bandied around at the time, because just the number of apartments that go onto the market, they are such poor investments, and people should be very, very wary in any city in Australia of investing in apartments. There's very, very few that make good investments, even over the longer term, even the older ones. If you look back historically, often, if they have had growth, it's barely been outside of inflation. And I can look back to apartments that were built in on the South Bank back in, 2008. And were initially sold for 800,000, and now they're selling for around 600,000. So these are properties where prices can go backwards. They're not good investments, and unfortunately, people get sucked into thinking that they are, based on this notion that we're all downsizing, which is false, which is not true. We're certainly not. And so, combined with the studies that we do at Prosper, which show that a lot of these properties are vacant in the longer term, plus what we've just been through with COVID, the fact that we don't have international students, and we're, we had an oversupply leading into this of apartments, plus the Melbourne plan to turn vacant offices into apartments. Well, I mean, it's just a disaster, and unfortunately, investors get caught in it, and you can't rent them, and if you try and sell them, you're going to have to really drop the price to try and find a few buyers. Unfortunately, I mean, obviously I deal with first home buyers, and they get sucked into this thinking, well, apartments are so cheap, and what's the point of me renting when interest rates are so low and all these grants are going around? I'll buy into the apartment market, and I always talk them out of it, show them a few stats, and they understand why it's a dangerous thing to do.
Well, it's interesting because I calculate investor stress in my surveys, and one of the highest stress postcodes is the centre of Melbourne, right? It's just high vacancy rates, low yields, negative net rental yields, in fact, quite often. And the theoretical gross return, where you compare the price with the theoretical rental, is completely meaningless because it's vacant for a lot of the time. So it's not surprising that but again, as you quite rightly say, people have to do the work to really understand the numbers, not just the high level statistics. And as soon as you start looking at that, then you'd want to look somewhere else. And then, of course, you've got the other question, which is about quality of construction, because we know that there are a number of those high-rise areas where flammable cladding's an issue, and where poor quality construction is an issue too. And that's something else that's a factor in.
On just about every block, you will find that they have construction issues. The maintenance issues are ongoing in apartment blocks, particularly the newer ones where you have lifts and so forth. You will always find that the lifts break down, the rubbish chutes get blocked, the pool heater goes. So the owner's corporation fees, another thing that's going to eat into your yield if you're an investor for a start.
Yep.
But they shouldn't be purchased. You rent because they're cheap rent. So if you want to live in an apartment because of the location, then rent it. Enjoy the cheap rents and bargain to get a cheaper rent. That's the other thing that people that are renting, any of your listeners that do rent, they should always check when it comes up for renewal of their lease what the other apartments are renting for. They should go online and just have a fish about and just see what apartments are being advertised for and try and negotiate a lower rent, because that's possible. Never be frightened to do that. That you've got you've never had more power than you've had now to be able to do things like that.
Yeah, that's great advice. And, the investor with a reasonable tenant will fall over backwards to try and keep that reasonable tenant, right?
Right now they will in Melbourne. I mean, this is the thing to understand about Melbourne. Melbourne's property market worked from population growth. And we don't have that at the moment. In fact, we have people leaving Melbourne because it's the city has been decimated from the continual lockdowns. People, I think it gets hidden. You listen to the news reports and it's like, well, we're offering you support. Unfortunately, that's not the case. I mean, there were retail shops that were already, many retail shops that were for lease before we even entered COVID. We had problems, in the economy where it showed cracks that you wouldn't see unless you were on the ground. And now COVID's just completely destroyed certain sectors of the city. People are leaving Melbourne. And the vacancy rates are high, not just in the apartment market. So this is another thing that you need to be very wary of if you're thinking of buying in Melbourne. Even in suburbs like Caulfield and Bentley, you have vacancy rates sort of 6 to 8%, which is very high. And so even if you think to yourself, well, I can get a decent rental because X property is rented for so much, that's not necessarily true. What you could get is a property where you can't attract a tenant unless you slash the rental. So this is a problem in Melbourne. It's not happening so much in the outer suburbs. So if you go further from the city, this trend of people moving away from the city, which kind of started before COVID, now there was a bit more impetus to push it with the work from home culture. As we move forward, it's going to get it's going to continue because we have transport innovation. So what we have now is flying cars being trialed. They're already here. And so you can think over the next few years as new technology develops and new transportation comes in, and the ability not just to work from home, but to live, be able to commute over longer distances much faster. It's only going to increase that trend of people moving outwards. And that actually could take a lot of inflation out of the boom and the bust cycle in property, in the cities anyway.
Yes, and as you say, as you go further out. And talking about further out, what do you say to first-time buyers who come to you and say, homeland package, end of town, edge of town, lots of government grants, great deal?
Terrible, really bad investment. I mean, you're second worst to the apartment market. The reason I say second worst is our biggest buying demographic are families with kids. So that's why you get housing that appreciates, it's under higher demand. Your property is only worth what you can sell it for. And the problem you've got in the outer suburbs is that the developers control the land supply. We have, Melbourne has a permanent urban boundary, and that means that, as soon as they established that and they said, well, we want to create a permanent urban boundary, the big developers rushed in and bought all the land up on options, from the people that would sell that land. And, they've got years. We do these studies also at Prosper Australia, where we can see, at certain times where they've had sort of 14 to 16 years of land supply held up, and they drip feed it onto the market in what they call staged releases. And that's done to keep prices high. And it's common sense for them to do that, right? Because they're a business and they want to make money. But it's not great if you're a buyer. You buy into a new estate and a house and land package. You're paying a lot for the property component of the site, not a lot for the land component of the site. The property is going to depreciate. The land can't appreciate because there's land always being drip fed onto the market with newer properties on than the property you now own 2 or 3 years down the line. So in new estates, prices don't go up. They usually stagnate or they go backwards until the suburb is all built out. So if you want a Melbourne example, Tarneet is a good example, or Point Cook. Once the suburb gets built out and the population is filled up, then there's pressure on the councils to put in some infrastructure. They put in a train station. There's no value capture mechanism to take away from what the train station does to land prices. So land prices go up, and that's where people suddenly get onto the mythological property ladder and can get some equity in their housing. But first home buyers should never focus on those areas. Unfortunately, you need to, you need to understand that if you're buying into the market, you're paying a high price for a reason. And that's because our economy is bent towards speculation on property. That's not a surprise to anybody. Everybody understands that. But you need to understand that if you're buying property, it's not a home. It's an investment in this country. You're paying a high price. So if you're paying a high price, you want to get a property that is going to continue to go up in price. And there's, the mechanisms to do that is to look at the established suburbs that have already been built up, that are surrounded by other suburbs, but people want to live there for some reason. Either there's a good school. If you take a good school, or it's close to the bay. If you take a bird's eye view of these suburbs, you can see that the land in them, the 600 square metre blocks, are being increasingly subdivided into 2, 3, 4 and 5 by the developers. And that means that the big land sites within those suburbs are reducing in supply, and they are therefore investment, sites that will appreciate in value just from the fact that they are reducing in supply. They have some development potential on them. They've got a rentable house on them. They appeal to a big buyer demographic. So, I mean, that's my advice, in short, to buyers if they do want to get into the market. And they're wise. You don't need to be pinned to the city to get the best capital appreciation. You just need, you can go further out from the city. You've got to get into an area that fits within your budget. But for your listeners that understand, that finally give up and surrender to the process in Australia, that we're in for this explosion in property prices, as we've seen over the last year, which is eventually going to decimate the economy. You need to be wise to it, and you need to use it to your advantage. We all must campaign against it. We should all speak out against it, because we would be a much better economy if it was the other way around and we were allowed to keep what we earn, and what we don't earn was taxed away. But unfortunately, it's not. We get taxed very highly on what we earn, and we can avoid tax through investment in property.
Yeah, and that is the fundamental disconnect, isn't it? We have a set of economic foundations which are unfortunately tilt everything towards property speculation, as we've discussed, but it's economically harming us as a nation, and it also means that we're not investing in the right things for the future more broadly in terms of the innovation that we need for next generation businesses. Those sorts of things are just not happening. So we've got very much a very old world type of economy, property-based economy. But you're right, it's just really tough for people trying to navigate where to go, what to do at the moment. That's why I always say to people, you've got to do the work. You've got to get detailed analysis of the area that you're looking at. And I quite often look at those intermediate suburbs that you're talking about and say to people, those land blocks, where you might have a property on 600 squares, they are getting quite rare now. And that's where the potential opportunity may lay. Certainly don't go to the edge of town on the homeland packages. That's destruction. And don't look at high-rise in the city, because that's wealth destructing too. So you've got that sort of intermediate ring that I think is where the sweet spot is currently.
Absolutely right. And they also need to be very careful with regional areas, because regional areas also have a lot of land around them that can be built out. So you have to, when you're dealing with the micro market, it really is that kind of supply demand thing. If the supply is reducing like the land sites are, then it becomes, something that is naturally going to attract. Your property is only worth what you can sell it for. You want it to attract a broad buyer demographic, and apartments only attract investors. 7 out of 10 investors buy into the apartment market. So when you come to sell, you're selling to one buyer demographic, an investor. When you come to sell property, whatever property it is, if you can appeal to, upsizers or downsizers and first home buyers and young families, and if you can appeal that your property is going to appeal to a broad number of people, then obviously that's going to be more security that you're going to be able to sell it, not just in a hot market, but also a soft market, because we do get certain markets within even an upswing of the cycle where prices become a little bit softer because, there's more supply on the market, or the heat has gone out of it for the time being, or one of the first home buyer grants have been wound back. But, the other item on this is that we, just looking at the broader economy, so much concentration now is on health. And land and where you live has a very big impact on people's health. And, in studies that have been done, I know from some of my colleagues in England, in people that live in London and have the a great deal of equity in their property and wealth, and they're surrounded by the best facilities and the best hospitals and the best shopping strips and the best schools, they have a much longer lifespan than people that live in the poorer areas as you travel north in England. And the same studies have been done in Melbourne and in Australia, where you can see the same dynamics, that people that live in the better areas have longer lifespans than people that live in the poorer areas, which are starved of facilities. And we would have a much different economy if the governments truly cared about health and didn't just try and cripple it even further to get on top of a pandemic, but really had health as their number one priority. At any time, we would have a very different economy than we do now, because it really does, the stress and of having to continually work out how you're going to provide for your family is a killer.
Yeah, absolutely. Well, I see that again in my stress surveys. And interestingly, when you talk to people, they just sort of assume, well, that's just the way it is. Yeah, that is the way it is, but it doesn't have to be like that. There are sets of policies, there are political decisions being taken which fundamentally are wired to increasing GDP at all costs, right? And I think that New Zealand might be onto something when they're saying, well, actually, maybe there should be other measures of success of a society beyond just GDP, right? Which, talk about wellness or talk about, other factors. But we seem to be so myopically based at the moment that many of those broader wellness and, the broader benefit issues just aren't being thought about.
I agree. I agree with what you're saying. I don't think we will ever do it under the structure of government that we have now, where we have, and a lot of countries have this, where they have two political parties that are going to get in, and those two political parties are constantly, dividing the country, and at the base of it, they don't have any different policies that are going to remedy the issue once and for all. And what we really need are sweeping changes. And I have some hope that at some point the structure of government might change, because it's a really archaic function. When you look at things now where you have citizen diplomacy, for example, on apps like Clubhouse, where people get together and they talk through how to move an economy, how to change things for the better, not just for themselves but for future generations. The problem is that in this country, so many people have their money tied up in wealth. Even at the political level, the conversations aren't, it might be an understanding that the economy would be better off if we didn't speculate on property and we were all allowed to keep what we earn. But the political, actually doing it politically is just a killer. And so nothing ever gets done. We need sweeping changes, and that's, and understanding of how those changes are going to transition in. The best time is in the downturns, is where all that wealth is gone. So really, a property crash, as painful as it is also a great opportunity to wipe the board clean and do those sweeping changes, but they need to be planned in advance, because whatever government is in at the time, the first thing they want to do is just revive things as quickly as possible. And money, as we've seen in numerous recent downturns, is poured into infrastructure. And when you pour money into infrastructure, the first thing that starts to explode in price are land prices. It's very, very sad.
Well, this is very interesting, and I really appreciate talking with you today, and specifically having this slightly more philosophical view of property, because it's something which I care passionately about personally. One of the reasons why I run DFA is to try and actually get some of these broader issues on the table. And as you say, we have to plan for the future rather than just sort of walking into it blind. And I just hope that we can perhaps continue to advocate for significant political change over time and take ourselves into a different, better future. But in the meantime, as you say, people have to make decisions based on the current property parameters. And even within the current parameters, there are winners and losers. And it's worth doing the work and being very clear about that when you actually think about engaging with property.
Absolutely. Absolutely.
Well, I really appreciate your time, Catherine. Thank you very much. And we'll put some links and things below. And I'm sure we'll be chatting again down the track.
Beautiful. Thanks so much, Martin. We'll talk soon.
Take care. Bye-bye.
Bye.